I know that the last video I have recorded has quite blurred with regards to the different account, the answer. So I'll be giving you this one so that you would be able to have a glimpse of what was the real answer from our last video. But hello there, if you are new to this channel, welcome, and don't forget to hit the big subscribe button below and click the little bell so you don't miss anything. And another thing, you could comment so that I would be able to get back to you if you have some questions with regards to this video and to the previous video. We are now going to tackle the account as compared with our ledger, because one of the one who viewed this messaged me and asked me about the difference between the ledger and the account. And hopefully you watch this video through the end, because I'm going to run some whole bunch of examples. Okay, let's start. So this is for the cash from our previous video on ledger. So this is the answer. So you should have an end balance of 56. Okay, next for our accounts receivable, you should have an end balance of 75,000. For our prepaid rent, so it's 30, only one transaction. And then for our computer equipment, we have 25,000. For our computer equipment, we have 25,000. My apology, this one should be deleted. We only have one computer equipment, remember? Okay, next for the supplies, you have 50,000. Okay, next we go now to our lay capital, the owner equity. So if you would see on our previous example, the beginning balance start with a debit, because as I had told you before, all assets has a normal balance of a debit, whereas capital and liabilities, which is capital, normal balance, her beginning and normal balance are usually the credit side. So if you would see, our capital investment has an ending balance of 100,000, because if this one is negative, then we could tell this as an abnormal balance, because the normal balance is credit. Okay, next we have the accounts payable. See, no more accounts payable, because if you would see, we already paid the accounts payable on March 30, so the ending balance is 0. So if the normal balance is still credit, the unearned, since it's also credit, we would discuss this later in our adjusting. So you would learn what are the accounts that are to be adjusted. See, you have now your unearned balance, unearned revenue at 50,000. Then we have the revenue, which is also normal balance as credit, 75,000. And then the expenses, I told you that expenses is just like assets, so its normal balance is debit. So balance should be 34. For our utilities, for salary, it should be 40. And then withdrawal is a contra capital account. That's why it has a debit balance, because at the end you will notice that the same will be deducted for the capital, because these are also called as nominal account. We will discuss nominal and real account on some other videos. Okay, so now let's proceed to our T account. So what's the difference between the account? First, if you would notice here, we put accounts. So what is accounts? Accounts, these are report or a description of event or experience. For example, if you would see cash, these are what? Here are the chronological activity that happened to cash. First, capital investment, we paid rent, we received cash from service rendered, we purchased supplies, we paid our creditor, paid our expenses, service rendered, payment expenses, and then withdrawal. So if you would see, these are chronological transactions that affect the related group of account. Okay, so what is now T account? Actually, T account, you could easily determine it by putting just the debit and credit. That's why it was called T account. If you would notice here, if we would hide the balance, and then this one, it would be forming almost the same as our T account, which is the debit and credit. So we would just have to put this one, since these are debit side, on the debit side. Okay? And then the credit side, sorry, on our credit side. Okay, we just put it here. So you would see this is also the T account. See, that's also the T account for our cash. So if we would check it, that would have just the same balance. $20,000 for our debit, and then how much for our credit? 200,000 for our debit, and we have for our credit as 144. So if we deduct, we have a debit balance of how much? 200 less 44. Then we have 56. So let's now check the right. It's the same as our ledger, which is also 56. See, debit balance of 56. Kasi if, for example, if this is a credit balance, it would be negative. Okay? Did you get it? Remember ha, that's what I told you before, that the debit balance normally for assets, asset, expenses, and dividend. These are normal balance with a debit. So, meaning it increases, it has a beginning balance of a debit and increases in debit. And it also decreases on the credit side. For liabilities, the normal balance is credit. So, it increases, it has a beginning balance of debit, usually have a beginning balance at credit and increases at the credit side. And a deduction will always be on the debit side. Okay? Now, so if you would check, this general ledger represent the record keeping of all the business and financial transaction. Because why? Because it has the money. So that you would determine how much it started and how much is the balance at the end of the period, so that when you summarize the financial statement at the end. Okay, now but take note, we also have the so-called double entry bookkeeping. And what's the double entry bookkeeping? Since we always said that the debit should always equal credit, it's mean that for every account, for every transaction, there are two different accounts that would be affected. For example, on hourly group, okay, on hourly group before, we have investment in capital by lay. So we have the cash, and then the other affected is capital. So see, this one is credit, so we put it on our credit side. Okay, so if you would see, the T accounts and the ledger are almost the same. Okay, if you have question, just comment below.